Building wealth isn't about luck or a secret formula. It's actually a sequence of small, calculated moves that anyone can follow. Most people fail because they try to run before they can walk. They buy the liability before they own the asset. Today, we're going to fix that by mapping out the exact order of operations. Let's start with the blueprint and follow each step. See? Step 1, Step 2, Step 3. It's that simple. This is the framework used by the world's most disciplined investors. The core problem isn't income, it's a lack of a structural foundation. Without a plan, every dollar that comes in finds a way to leak out. We call this the financial leak, and it's why many high earners still feel broke. To stop the leak, we must prioritize the first step, the starter emergency fund. Historically, having a small cushion prevents you from sliding back into debt. Think of this as your financial insurance policy against life's surprises. Step 2 is capturing the free money, your employer's 401k match. On average, a company match is a 100% immediate return on your investment. It's simple math. $1 plus $1 equals 2. That's free money. Make sure you're taking full advantage of it. It is mathematically impossible to find a better deal than this. Once the match is secured, we move to high-interest debt elimination. High interest is a headwind that keeps you from making any real progress. By clearing this, you're essentially earning whatever interest rate you were paying. Now, we complete the foundation, the full emergency fund. Typically, this is 3 to 6 months of your essential living expenses. This isn't just a number, it's the psychological freedom to say no. With your foundation set, the momentum shifts toward true wealth building. We now begin maxing out tax-advantaged accounts. In many cases, the Roth IRA or HSA offers the best long-term growth potential. What tends to happen is your money begins to work harder than you do. This is the crossover point, where investment returns exceed your labor. Here's how it works. Your work income stays flat, but your investments grow and cross over. And there it is. The final step is the brokerage account, the ultimate flexibility phase. This is where your financial strategy unlocks true potential. With these flexible options, you can adapt to any market change. This is money you can access at any time, for any purpose, without penalty. The order of operations is simple, but the discipline to stick to it is rare. Start with step 1 today. Your future self is counting on it. With your foundation set, we enter the most dangerous phase, the messy middle. This is where lifestyle creep begins to erode your progress. You earn more, so you spend more, and your net worth stays flat. To defeat this, we use the 75% rule for every future raise you receive. By automating this, you enjoy your success without sabotaging your future. Next, we optimize your tax alpha to keep more of what you earn. This means understanding the difference between pre-tax and Roth accounts. With a pre-tax account, you pay taxes later. With a Roth account, you pay taxes now. So, Roth is tax me now. Historically, tax rates change, but tax-free growth is a mathematical certainty. Now, we look at the hyper-accumulation phase of the order. This is where you aim to invest 25% or more of your gross income. It feels aggressive at first, but this is the well speed run. Typically, 5 years of hyperaccumulation can do the work of 20 years of normal saving. At this stage, we must address the boring middle trap. This is the period where your portfolio is growing, but not fast enough to change your life yet. The temptation to tinker with your strategy is at an all-time high. But in investing, activity is often the enemy of performance. What tends to happen is the more you move, the more you pay in fees and taxes. Step 7. Evaluating low-interest debt, like your mortgage. With rates this low, it's not your biggest worry. You can prioritize other debts and investments first. This makes financial sense. On average, if your debt is under 4%, there is no mathematical rush to pay it off. Your capital is often better served staying in the market where it can compound. Now, let's talk about the portfolio milestone psychology. The first $100,000 is historically the hardest to accumulate. After that, the compounding engine takes over the heavy lifting. At this point, your money earns more in a year than you did your first year working. Step 8. Big purchases and philanthropy. This is the stage where you've earned the right to loosen the grip. Wealth is a tool for freedom, not just a score on a screen. If you don't use it to improve your life or others, it's just paper. The order of operations ensures you never have to choose between survival and success. It provides the rules of the road so you can drive with confidence. Now, let's address the most common mistake, comparing your step 1 to someone's step 9. Social media creates a false sense of financial urgency. True wealth is built in the shadows, not in the spotlight. It is the result of thousands of boring decisions made correctly. When the market drops, your plan becomes your anchor. Historically, every market downturn has been a precursor to a new all-time high. Panic is a luxury that the disciplined investor cannot afford. The sequence we've mapped out is designed to protect your human capital too. By reducing financial stress, you perform better at your primary career. This creates a positive feedback loop of higher income and higher savings. As we approach the final steps, remember, complexity is a cost. You don't need complex hedge funds or exotic assets to reach your goals. The simple path, followed consistently, is the most effective. Wealth isn't about the one big win. It's about avoiding the one big loss. By following this order, you've built a system that is resilient to life's chaos. You are no longer a victim of the economy, you are a participant in it. This is the calm authority that comes with financial clarity. The steps are clear, the math is proven. The only variable left is you. Will you take the first step today, or will you wait for a better time? Wealth is a marathon, not a sprint. I'll see you at the finish line.